How banks really make money. Most people think banks just keep your money safe and give out loans. But the truth is, that's only part of the story. Banks are like financial factories, turning your money into more money for themselves. Today, we'll reveal exactly how banks make money, explained simply and clearly. When you deposit money into your bank account, it feels secure, as if your cash is sitting in a vault waiting for you to withdraw it anytime. But in reality, that's not how it works. Banks only keep a small fraction of your money in reserve, just enough to handle day-to-day withdrawals. The rest of it, they lend it out to businesses, home buyers, and other borrowers. And they charge interest on those loans. This system is called fractional reserve banking, and it's the foundation of how modern banks make money. Let's break that down. Suppose you deposit $100 into your account. The bank might keep $10 as a reserve and lend $90 to someone else. That borrower spends it, and the money eventually ends up in another bank, which again keeps 10% and lends out the rest. Through this repeating cycle, your original $100 can multiply into hundreds of dollars circulating in the economy. And every time a loan is made, banks collect interest. That interest is the first major way banks make money. But the real profit comes from something called the interest spread. The difference between what the bank pays you for your savings and what it earns from borrowers. For example, the bank might pay you 1% on your savings account, but charge someone else 8% on a car loan. That 7% difference, minus costs and defaults, becomes profit. The bigger the spread, the bigger the bank's earnings. Of course, banks don't rely only on interest. They've built a whole ecosystem of extra revenue streams, credit card interest, and late fees. Checking account charges, wire transfer fees, investment products, and even trading and asset management all bring in additional money. Each service adds another trickle of income that, combined, creates a steady river of profit. That's why even if interest rates change or the economy slows down, big banks keep earning billions. On a global level, all these activities have an even bigger effect. They actually create money. That's right. Banks don't just move money around. They generate new money through lending. Every time a loan is made, new digital money enters circulation, expanding the money supply. This is how economies grow, though it also contributes to inflation over time. And now, artificial intelligence is reshaping this entire process. AI helps banks predict which loans are likely to default, detect fraud in real time, and optimize investment decisions. It even powers personalized financial recommendations, showing you credit cards or loans tailored exactly to your spending behavior. For banks, AI means higher efficiency, fewer mistakes, and more opportunities to profit, all at lightning speed. So, how do banks really make money? By using your deposits to fund loans, by charging more interest than they pay, by collecting fees on almost every service, and now by using artificial intelligence to optimize it all. Your money is never just sitting in a vault. It's constantly being put to work for the bank. Next time you walk into one or check your account balance, remember, every dollar you deposit becomes part of a much larger financial machine. And now you know how that machine really works.